wanted to give you all an update on 3 items, and you've got a good roster of speakers from the delegation who will be giving you an update on our work in Washington and what we look forward to for 2017. But I thought I'd touch on 3 items, really briefly just touch on the drug epidemic in the Commonwealth, our 6th Congressional District Drug Abuse Task Force, and the recently enacted Comprehensive Addiction and Recovery Act. Then I'd like to touch on the work of the House Financial Services Committee, on which I have the privilege to serve, and then finally talk about a better way for a more confident America, our agenda, the House Republican majority agenda for 2017, and highlight the work that we've been doing on the Empowerment Initiative in the Republican Study Committee and on Speaker Paul Ryan's task force to improve on America's anti-poverty efforts, which is a critical component of our Better Way agenda for 2017. First of all, the drug epidemic that we all are facing in this Commonwealth. Kentucky is unfortunately 3rd in the nation in terms of the highest drug overdose mortality rate. This is negatively impacting our business community, our employers community, because of the workforce issues that this creates. As I travel my district and talk to HR managers and as I talk to plant managers, it is very, very challenging time indeed for employers to find drug-free on-time labor. And this is a big issue for, I know, members of this organization, and we need to deal with this issue, and not just for the labor market problems that's creating, but because of just the heartbreaking stories that we're hearing from fathers and mothers and sisters and brothers and the families in our communities that are torn apart by the opioid and heroin addiction crisis. And now we see the dangerous introduction of these synthetic drugs, fentanyl, and the other pills that we've seen. We convened a 6th Congressional District Drug Abuse Task Force where we brought together experts on the front lines in this fight from all different areas, from the education and prevention communities, from the law enforcement, the judiciary, federal law enforcement, the DEA, the U.S. Attorney's Office, to the local levels, the drug courts, and the local prosecutors and local law enforcement. We also brought in the treatment folks, the University of Kentucky Department of Psychiatry, the emergency room physicians, the first responders, the paramedics, and also the recovery people, the faith-based institutions, the pastors, the psychiatric hospitals, and the nonprofits that help with recovery. And what we found was we convened our first meeting with the director of the Office of National Drug Control Policy at the Hope Center, one of our treatment centers in Lexington. And we found that breaking down these silos and introducing communication and strategies across these different areas was very, very helpful. We met 3 subsequent times. We accumulated some recommendations from all of the experts from our district, and we took them back to Washington. The House was able to pass 22 separate bills that included things like an interagency task force on prescribing practices for our physicians, abuse deterrent technology for our pharmaceutical companies, partial fill policies so that if you're a sports athlete with an orthopedic surgical recovery, you're not bringing home 30 OxyContin pills. We looked at neonatal abstinence syndrome, and all of our hospitals from the University of Kentucky to our rural hospitals are seeing an increase in uptick in the number of babies who are born addicted and are the most innocent victims of this tragedy. We had a pediatrician from the University of Kentucky, Dr. Henrietta Bada-Elzy, who recommended a comprehensive national study on best practices on how to deal with NAS. We incorporated that in legislation called the NAS Healthy Babies Act. More resources for drug treatment beds, more funding for drug courts and veterans treatment courts. First responders need assistance with Narcan because we know we can't help folks in recovery if we can't save their lives on the front end. So in the end, the Senate did its work, the House did its work, bipartisan, bicameral. President Obama signed the bill into law on July 22nd, and the Comprehensive Addiction Recovery Act is a step in the right direction. Now, Clearly, one bill from Washington, one piece of legislation will not solve this problem. This is an epidemic that will require partnership with local, state, local officials, the institutions of private society, our hospitals, our emergency rooms, our nonprofits, our faith-based organizations. But Congress has a role. We recognize that role, and we want to help. And I think the CARE Act is a step in the right direction. And I would just note, we're very proud of the fact that professionals in this fight from Central Kentucky played an important and participatory role in the legislation. Secondly, let me just address some of the work that we're doing in the House Financial Services Committee. Speaker Ryan, when he was elected as Speaker, challenged the House Republican majority to be not just an opposition party, but to be a proposition party, that if we're going to truly save America, we need to have ideas. And one of the ideas that is central to getting our economy back on track is to deal with the overregulation in our financial services sector. The Dodd-Frank law, when it was enacted in 2010, the promises of that law were that we were going to lift the economy, we were going to solve the problem of too big to fail, we were going to produce financial stability, and we were going to protect consumers. But 6 years later, and we had our 6-year anniversary back in July, none of those promises have been kept. In fact, the economy is still underperforming significantly. We saw, I think, the second quarter growth rate at only 1.1%. We really need to be growing at about 3.5% to 4% to get the country moving based on population growth in terms of robust growth, solving these big problems, full employment. Labor participation rate still remains the lowest it's been since the late 1970s. In Kentucky, we need about 140,000 more people in the workforce just to be average. So Kentucky's even behind a lagging national labor participation rate. Wages are pretty stagnant in this country still, and poverty has increased. 7 years after we officially came out of the recession, there's 7 million more Americans struggling in poverty today. So certainly we didn't lift the economy with the law, and then we didn't produce financial stability. Too big to fail is a bigger problem today. Jamie Dimon, the CEO of J.P. Morgan Chase, the largest institution in the United States, tells us that Dodd-Frank actually gives him a competitive advantage. It's a moat. We've lost 1,700 community financial institutions in our country. We've reduced competition and choice in banking. There's more consolidation. There's more M&A activity in our banking sector, and there's a lot of failures among our small community banks because they simply cannot afford the avalanche of red tape and compliance costs that are the result of the 400 new rules and regulations stemming out of the 2,300-page Dodd-Frank law. So this has been negative all the way around. What are the examples of consumer harm? What happens when you have less competition and choice in financial services? Before Dodd-Frank became law, there was 75% of institutions in this country offered free checking. By 2015, just 37% of banks offered free checking. Dodd-Frank regulation fueled a 21% surge in checking fees, and the mandatory minimum account balance needed to qualify for free checking is also increased. There are 15% fewer credit card accounts since 2008, and on average they cost 200 basis points more. Median household income has fallen, and the personal savings rate has fallen from 6.1% to 5.2%. According to the Federal Reserve, when fully phased in, 1/3 of Black and Hispanic mortgage borrowers will be hurt by Dodd-Frank's qualified mortgage rule. So many community banks in this country, particularly the smallest community financial institutions, are simply getting out of the mortgage lending business. Some people refer to the qualified mortgage rule, the so-called QM rule, as the quitting mortgages rule. Many community banks are telling us that the regulatory burdens are preventing them from making these kinds of loans. The average cost of commercial industrial loans has increased 10%. New business formation, which is a real important indicator of economic health, new business formation is at a 35-year low. And one of the reasons why there is less entrepreneurship in this country is that small business lending from banks is at a 20-year low in this country. And even for existing businesses, refinancing is challenging. In the first quarter of this year, 40% of existing small businesses in America had to access their personal savings in order to keep those operations going, quite simply because it's harder to access credit. Also, consumers have been harmed by, ironically, the very agency that was set up to protect consumers, the so-called Consumer Financial Protection Bureau. Why? Because we're wringing competition and choice out of the financial marketplace. Credit availability is challenged now because of the CFPB, which is the least accountable and least transparent agency in the entire federal government. The way this bureau was set up was through funding from the Federal Reserve instead of the typical congressional appropriations process. It's not a bipartisan commission like many other financial regulators, and so it's highly politicized. They politicize the allocation of credit through a program called Operation Choke Point in conjunction with the Department of Justice and the FDIC, which punishes lenders for lending to certain politically incorrect businesses. So it's politicizing the allocation of credit. It's taking away choices. It's making it more difficult to access credit and obviously compromising capital formation. And so small businesses in this country are finding it more and more difficult to grow and create jobs. What we've tried to do is reform the CFPB, and one of our proposals, a bill that I introduced called the TABS Act, would finally subject the CFPB to congressional appropriations to provide for meaningful congressional oversight over this rogue bureaucracy. They're now trying to eliminate, it's not just about small dollar lending, it's about eliminating arbitration clauses, it's about taking away consumer choice in auto lending, it's the qualified mortgage rule, it's in a whole range of financial services and products that are simply going to go away, or the costs are going to go up because of overregulation in that area. So the Dodd-Frank law has been a spectacular failure in terms of lifting the economy. It has not produced financial stability because too big to fail is a bigger problem today. Larger institutions are larger. There are fewer choices in community banks and credit unions today than there were when the Great Recession ended and when we came out of the financial crisis. Financial stability hasn't been enhanced. We have done nothing to actually address the real underlying causes of the financial crisis. So what are we going to do about it? We propose the Financial Choice Act, which is an off-ramp from the Dodd-Frank law. None of the institutions that failed in the financial crisis were adequately capitalized. But banks and credit unions and financial institutions, they cannot afford to be adequately capitalized when they have to deal with the skyrocketing cost of regulatory compliance. So our proposal is this: we will produce financial stability without undermining economic growth. We will take bailouts off the table, and we will stabilize our financial sector, but we will do so not through central planning in Washington, not by micromanaging our financial sector, but instead by requiring well-capitalized banks in exchange for regulatory relief. So you get an off-ramp under our proposal from Dodd-Frank and all of the micromanagement from Washington if you are adequately capitalized, if you maintain a simple leverage ratio of 10%. For most of our community banks and many of our regional banks, that is a trade-off worth taking. Some of the Wall Street banks say that they may not be able to escape with that leverage ratio, but we think we're giving them a choice. And obviously, the current designation process by the FSOC, the Financial Stability Oversight Council, it only perpetuates systemic risk because FSOC is designating these large institutions as too big to fail, which means they're first in line for a bailout. In the Financial Choice Act, we provide an array of regulatory relief, including the top priority of the Kentucky Bankers Association, which is Portfolio Lending and Mortgage Access Act. That would allow well-capitalized banks to take on and retain the risk of non-QM mortgages, retain that risk portfolio, those loans, not only to encourage safe and sound lending practices, but also to responsibly expand access to mortgage credit. So that's basically the architecture of the Financial Choice Act. Well-capitalized banks get an off-ramp from Dodd-Frank. This will truly lift the economy. This is going to expand access to credit, help capital formation, but also deal with safety and soundness in ways that we did not see in the Dodd-Frank law. In my remaining time, I want to touch on another area that we're working on in the Financial Services Committee, in the Housing Subcommittee, because I'm on the housing subcommittee, we've been able to plug into our anti-poverty agenda. What we found in reviewing as the chairman of the Republican Study Committee Empowerment Anti-Poverty Task Force, what we found was that the war on poverty over the last 50 years has been really a breathtaking failure. In 1965, when President Johnson declared a war on poverty, his goal was not just to deal with the symptoms of poverty, but to cure it and prevent it. Well, in 1966, when most of these policies went into place, the 80 different welfare policies spread across 13 different federal agencies, when they went into effect, the official poverty rate in America was 14.7%. In 2014, the official poverty rate was 14.8%. If you are born in poverty today, you're as likely to remain in poverty for the rest of your life as you were back in 1965 when President Johnson declared a war on poverty. The sad reality is we've spent $22 trillion making poverty more tolerable, but not helping people actually escape poverty. Most of the welfare programs that we have today replace work. They don't encourage work. And what we know about work and work requirements from the 1996 welfare reform is that child poverty rates plummeted after work requirements were imposed as a condition of receiving public assistance, and single mother employment skyrocketed as a result of work requirements. And we know that work is the single greatest indicator of whether or not one can escape poverty. Of all of the workers in this country who have a full-time job, the percent of those individuals who live below the poverty line is only 2.7%. So a full-time job is the best way that people can escape poverty. Our objective in our Better Way for a More Confident America is to restore the American dream. What is the American dream? The American dream is the idea that the condition of your birth does not determine the outcome of your life. Every American, regardless of their situation or circumstance, should have a right to rise. And unfortunately, the $22 trillion that taxpayers have spent over the last 50 years have maybe made the conditions of poverty a little more tolerable. We might have, on the margins, help people deal with poverty so it's a little less painful, but we really haven't measured the results in ways to determine how many people are we not just enrolling, how much money are we spending, how many homeless people are we sheltering or warehousing in public housing. But the better question is, how many people are we graduating from these programs? And that was the question that I asked Secretary Castro in our hearing on the 50 years of HUD. How do you measure success? He measures success, he said, how many people are we putting a roof over their head? I said our aspirations should be higher. Our aspirations should be, we should measure success based on how many people are we graduating into permanent, non-subsidized housing. And so the centerpiece of our reform program is, yes, to measure success based on those metrics, but also work incentives as a condition for receiving food stamps, public housing assistance, or any other public assistance for able-bodied, working-age, work-capable adults. 44% of individuals who receive Section 8 housing vouchers are able-bodied, working-age people. So if you're able-bodied, if you're working-age, and particularly if you don't have dependents, we think that you should be working or preparing for work, acquiring skills, because we know this is the most compassionate policy to help people achieve self-sufficiency, dignity, and upward mobility to restore the American dream. We all want this. Whether you're a Democrat or a Republican, a liberal, conservative, 7 out of 10 Americans are telling us that they think the country is moving in the wrong direction. 7 out of 10 Americans think that the American dream is in the rearview mirror and that the right to rise and upward mobility is no longer available to them. That's what Bernie Sanders supporters are saying. That's what Donald Trump and Ted Cruz supporters are saying, is that we need upward mobility in this country. And so what we say is that if you're able-bodied and working age, let's require work or doing some things to prepare for work as a condition for receiving public assistance, because work is not a punishment. Work is a blessing. And we believe that low-income Americans are not liabilities to be managed by some distant bureaucracy in Washington, D.C. Low-income Americans or no-income Americans are assets, untapped potential, and we need to give them the dignity of work to achieve self-sufficiency so that they can put food on their table for themselves and their families. And we know this is a big deal in the labor market in Kentucky because every HR manager and plant manager that I talk to say there are jobs available. And to simply say we're going to raise the minimum wage when there are $14 an hour jobs available for unskilled workers is crazy. The fact of the matter is, many of the employers in my district, they tell me, we cannot compete with a government that is paying people to not work. And so this is a better way for a more confident America. This is a better way to give people dignity, hope, and upward mobility. Thank you very much.